Hey everybody, welcome to this free edition of our Trade Use Group Weekly Roundup for the trading week ending August 19th, 2022. I'm Preston Brent. Thanks for tuning in. This week's theme is, well, if it looks like a duck and quacks like a duck, is it really a duck? I guess to put it another way, the markets are trading like it's a bull market, but is it really a bull market? Well, let's kind of dive into the details and just take a look at where we've been and what looks like we can expect over the next month or two. If we come in here and look at the prior week and just see how the markets fared, of course, everybody was in the red for the week. You can see here that the biggest loser was a Russell, followed by NASDAQ, then S&P, then Dow. Everybody's still in the red year to date. Best performers for the week, energy and worst staples. We had energy leading year to date and communication services bringing up the rear. But as you can look over in the upper right, you can see the forward PE ratios at 18.38. And the 10-year Treasury moved up a pretty good bit this week. It moved up to almost 3% at 2.99%. It's about 145 basis points higher than the S&P dividend yield. And the earnings yield for the S&P is still coming in a relatively robust 4.84%, but with inflation still very high, the real yield is still a negative 3.76%, which means you are losing money based on inflation. Current VIX closed out the week at 20.60, the prior week 20.53. So even though, as you can see, the markets finished lower, volatility-wise, we didn't really get a big movement in the VIX. Typically, when we've moved down this year to the 20 zone in VIX, then we've seen the markets bounce higher on the VIX, or markets move lower and the VIX bounces higher. But we haven't seen a big movement up. That would tell me that what we're going through right now is more of a just consolidation phase of that prior 4-week run that we've had in the U.S. indexes. Okay. We did this past week, James Bullard, who's the St. Louis Fed president, he had kind of a hawkish statement. He's known as more of a hawk, but he indicated that inflation may not have peaked statistically, and he's on board with voting for a 75 basis point rate hike. Okay. And that kind of put a damper in the mood in the markets midweek. We did get the release of the Fed minutes, but there was really few surprises in that. It does show the Feds are debating just how tough they're going to get in this upcoming September meeting on hiking the rates. And I will note for you guys out there, since the bear market, the dot-com bear market in 2000 to today, roughly half of the S&P's best trading days have taken place in a bear market, because you typically get a big move up, a little bit of a combination of some money coming in trying to test the bottom, as well as probably even more so a squeeze, and just forcing markets higher on buying to close those shorts that are being squeezed out of the market. So just understand, even though we've had a 4-week run, it could all end very quickly if the markets underestimate the severity with which the Feds may hike rates in the future. And we're going to get more headlights on that, and I think we need more data to be able to just make a determination, have the lows been made? Because I see on TV talking pundits, many of them have said the lows have been made. Others have said they've not so far this year. So we'll just kind of hang in there and see what happens. Okay. And of course, if we look at this week's data, economic data, retail sales came in a little bit stronger than expected, rising 70 basis points. You know, once you take out the volatile auto and gasoline and energy segments. So we're seeing that the consumer is still spending. Industrial production was also a little bit stronger than expected, came in at 60 basis points this month, roughly about twice what was expected. And although weekly jobless claims ticked a little bit lower, and the housing data ticked lower, we are seeing the consumer so far is fairly resilient. But I'm starting to see cracks in consumer spending. And should the consumer spending item pull back a little bit more and increase, then we can see a little bit more dampening of the enthusiasm of more upside movement in the markets. Okay. But like I said, so far, a lot of this pullback is more of a consolidation of a big move that we had, and just a couple of data points from the Fed. Okay, if we go across the pond and take a look at what's going on over in Europe, you can see that the Euro stocks, the CAC 40 and the DAX were all underwater this week. The FTSE in the UK is actually stronger. It's really the only one over in Europe that's in the green year to date. Okay, that's the London exchange. It's the only one up year to date. Okay, and if we look there at the UK, their headline inflation this past week came in for the first time since 1982 at double digits. It hit 10.1%. Okay, unbelievable. And they're getting hit with energy cost, food cost, just huge data, right? So we're seeing all of this, and their regular wages with wage hikes across UK declined 3% if you factor in inflation. So all in all, not very good, right? And then of course, if we look at unemployment, it's sitting at about 3.8%, much like here in the US. So fairly strong employment numbers, but inflation is through the roof, and I suspect the Bank of England is going to have to hike more. All right. Meanwhile, Eurozone inflation also hit a record 8.9% in July. So it caused some of the analysts over there to lower the estimate of second quarter economic growth to 60 basis points from 70. There's going to be some, I think all of Europe is going to have a harder recessionary hit than if we're in a recession or get hit with a recession in the US. I think it's not going to be very pretty. Okay. Now, if we look at the Asian markets, you can see over here, Nikkei was in the green both weekly and year to date. China and Hang Seng both in the red for the week and year to date. And let's look at Japan for a second. Their GDP actually expanded at an annualized 2.2%. Now, they were expecting 2.5, but it came in at 2.2. So it missed their consensus estimate. But we did see over in Japan industrial production increase about 9.2%, higher than expectation. Inflation also remains above their 2% target number, came in at about 2.4%. But Japan's got other issues other than just inflation. They're trying to keep inflation higher, and that was one of their goals. But the yen is very cheap right now. If many of you that are currency traders know, the yen has just fallen off the table. It's trying to find a bottom against the US dollar. So that's kept inflation up a little bit because everything is a lot more expensive with a cheaper yen. And of course, if we look at the Asian markets, China and Hang Seng, China's market posted a loss for the week. Basically, they've got weak economic data coming out. We also saw elevated levels of COVID, putting more fear out there that, well, will they do their zero policy and shut down some of these areas, which is what they've done in the past. It's destroyed their economy. And they're having huge drought. No rain. It's just hot as hell there. So you throw that in with energy problems, people forced to stay in hotter than expected apartments, things like that. Just not good. And their retail sales grew year over year only 2.7%. So not very good in that area. In fact, we're seeing some big hedge funds and money markets pulling money out of China for a number of reasons, besides the fact that they're slowing, but because of some of the geopolitical areas and China making it harder and harder for foreign investors to come in and actually get true insight into what they're investing in. We're also seeing they're still having a big major real estate problem there. Their home prices fell. It's 11 months in a row now. Their home prices have fallen. Okay. And over new home prices and over 70 cities declined, I think 11 basis points in June. So all in all, not very good in China. Okay. So let's just go take a look at the markets. I'll show you guys a couple of things and just kind of where we're sitting. Let me just move the screen over. It'll take a couple of seconds here for your screen to adjust. And then what we're going to do is take a look first at the E-mini S&P 500 futures, just to see where that is coming out. And if you look at the screen there, you've got the futures contracts. And you can see This yellow line is the 200 EMA, exponential 200 EMA, right? And as I said before, once we spent 3 days here and we moved up, more than likely we're going to test it. And we came down intraday and actually tested the 200 and we're holding up. So what I want to see for this coming week as we round out the month of August. Remember, this past week, Friday was an option expiry, and we had a lot of options that were expiring on Friday. And that typically on expiration day, you tend to have a little bit of an uplift in the market, but that clearly wasn't the case this Friday with some of the negative comments on interest rates and interest rates moving higher. But you can see we tested the 200 EMA. I want that to hold next week. If we break the 200 EMA, then you're going to see price action come down to this 41.75 area, which is a 23.6% fib node. All right, it's a very, and you could see where we hung up here for almost 2 weeks, right? So that'll be the next test. Should we take out the 200 EMA? This is a bear market chart. Anytime you have the 50 below the 200, the 50 is the red line, the yellow line is the 200. So anytime you get below the 50 gets below the 200, it is a bear market chart. And these two become like Velcro or honey to an outdoor picnic and ants. It is very attractive for price action to bounce around these. A lot of algos are programmed in on the location of the 50 and the 200 and whether we're in a buy the dip or sell the rally. Traditionally, when the 50 is below the 200, it is the sell the rally. Now, we've had a very strong rally off the lows. As you can see here, if we step it back, our low for the year for the E-mini S&P 500 futures, we were down 24.32%. Not significant, but enough to call it a bear market. And we hit it on June 17th. So we're a couple of months away from these lows, and you can see we've been making higher highs and higher lows along the way. So obviously, this first test was the 50 EMA. And at our last Fed meeting, you can see here on that Fed meeting how the Feds came in a little bit more dovish than everybody expected. And then because we had actually moved beyond the 50 EMA, fell below it. And in the Fed meeting, it just moved us straight up and we took off, right? And then we held up here for a while at the at this fib node, this green line, and then boom, we took off. So now the next test is going to be where are we in relation to the 200 EMA in relation to this pivot high sitting right here, okay? So that's going to be what's going to be resolved probably over the next week as we go into a big Labor Day weekend here in the United States. First weekend in September, which would be the weekend after next weekend. So we got a couple of weekends and we move into a holiday weekend, and then we start the last month of Q3. All right. So that's a little bit about what I'm seeing in the markets here. And if we come over and we look at, let's say, the NASDAQ, which has made a big, even bigger rally off the lows here. You can see the lows in NASDAQ were a day earlier, June 16th. We were down about 34%. But you can see with NASDAQ, we could not hold the 200 EMA and actually broke it on the 17th this past week. So we didn't break it on Friday. We broke it on the 17th, which I think is a Wednesday. With NASDAQ. Now understand the S&P is sitting just slightly above. So let's watch the price action here. I do believe if interest rates are going higher and the markets interpret Fed Bullard's comments as a little bit more hawkish than the markets had priced in, we're going to see a little bit more pullback in the technology sector, okay? The support area for technology is at 12,786, which is the 50 EMA. All right. These two, like I said, like honey at a picnic, they attract all the bugs and ants and flies. And for algos, price action is drawn to these two. But we've got bear market charts on every index. So let's just let this dip play itself out. I suspect it will. I suspect we will go higher unless we get news from the Feds. Now, we've got a huge meeting coming up in the next couple of, a 2-day meeting coming up in Jackson Hole, Wyoming. All right. It is the big area where all the central banks get together, right? We'll get Boom Boom Powell, we'll get Christine Queen Bee Lagarde. It's usually a 3-day economic policy symposium. It's always held every year at Jackson Hole, Wyoming. Okay. And the title this year is Reassessing Constraints on the Economy and Policy. How appropriate. So we're going to get all of this, the muckety mucks there speaking and in front of TV. That will affect the markets. Okay. And depending on what Boom Boom Powell and Christine Queen Bee Lagarde, the head of the ECB, come out with, it's going to be, and primarily Boom Boom Powell, that's going to help drive price action up or down based on as they figure out just where they're going to stop their terminal interest rate hikes. And keep in mind, we've got a Fed meeting the third week in September. So in about 4 weeks from now, roughly, we're going to get that movement as well. And it'll help to kind of clarify just where the Feds are coming from. And also by then, we will have had another inflationary data report and a wholesale inflationary report from the business community. And that'll give us a pretty good clue. Right now, I think we're going to get a little bit more of a dip, is kind of what I'm seeing. And if we look at the VIX, you can see the VIX. We're every time we come down to this 20 area, we tend to bounce and move back up. Okay. Now we are getting the 50 crossing below the 200 on the VIX, which is more of a calming effect on volatility. Remember, volatility charts are just the opposite of the index. You know, when volatility is going down, that's a good thing. When vol is going up, that's not a good thing. So when the 50 EMA is over the 200 EMA, that's not a good thing. So we want the 50 EMA to move below. So typically when that happens, it shows a huge resistance point and vol to slightly rest a little bit. Now there are stats that come out that as long as volatility is over 15 and under 20 in that range, markets don't fare that well over a 12-month period, 3 or 4% returns, those kind of things. But when the VIX gets below 15 and stays below 15 for more than a month at a time, then the 12-month returns on the markets are upwards of 8 to 10% or more long-term average, or even more. Okay. So we've got to watch this and see where we stand. So that 50 EMA crossing below is going to have a little bit of a calming effect. And the only thing that can reverse that is if we have a really bad couple of weeks to see the VIX come back up mid-20s. All right. I don't see that. In fact, if you look at the market action on Friday, the VIX, it was up, but it was not up in a panic type of move. It was more of an orderly move, like this move lower here in the VIX, in the movement that we've gone up. And I don't see any divergences here either. So that does suggest that we're probably going to move up just a little bit more, get a little bit more consolidation in the markets. Okay. If we come down here and look at Treasuries, well, Treasuries moved up. Or the bonds moved down, so interest rates moved up. You can see we broke back below the 50 EMA, okay? As bonds move lower, interest rates move higher. And I think the interest rates are moving higher because they may have underestimated the degree of aggressiveness that the Feds are going to be coming out over the next 3 to 6 months in hiking rates. That is what's pushed some of the market action down, primarily in the tech sector. Okay, and small cap sector. So that's a little bit about what I'm seeing. And if we look at the 10-year interest rate, you'll see it moved up, right? We're coming back up over the 50 EMA, and we're moving back up here. I don't believe it's going to get too high, and I believe it's going to roll back over again, but we got to let it work its way out, okay? And of course, what's also helping some countries, hurting others, look at the strength of the dollar. Now it's setting up to roll back over. I would like to see the dollar. In fact, my estimate of the dollar, if I were to just put an estimate on here based on Fibonacci, Gann, and Elliott wave theory, my target, and this kind of uses a little bit of both to create a target, is up around 110. That means we will move into above parity for the euro. Okay. And then if we do get up in this level here, I would be more than willing to go long the euro. and short the US dollar. But at this point in time, you can see that strong move up. If we look at the euro, you will see it's close to parity. Okay. My target for the euro was slightly below parity at 0.99. So you can see it, they both line up. The target for the euro is down just a little bit more, and because they're going to have a rougher recessionary environment than the US, they're not going to have a soft landing. And we're seeing it already in the economic data coming across in the UK and the rest of Europe. So that means the euro is probably going to be a little bit lighter on the foot. And the euro, as you guys know, is about 58% of the dollar index. So the dollar index is really an index or a basket of currencies. So where these other currencies go is what drives the dollar. You can see we cannot get above the 50 EMA right here, over here. And of course, if I back it up, you can see right here. See how long we sat at the 50 EMA, this red line? It just can't get over it. So that would be the overhead resistance. We failed again, which suggested more downside. You can see my targets have been on an ongoing basis. I've lowered my target. My original target was 107, then it was 102, and now it's 0.99. All right, we're just going lower, and the target becomes the overhead resistance point should we move below the target. So that's a little bit about what I'm seeing in the currency side. And of course, if we look at metals, as you guys know, I am not a gold bull right now. I'm waiting it out. You can see here how we did move up, but we ran into huge resistance on the 200 EMA, blew through the 50, and we're hitting the original target that I had for gold right here. I think it could run a little bit lower in the gold markets. In fact, I have a target projection down here around 1600 for gold. Okay. And if interest rates go much higher and the dollar stays as strong as it is and Europe gets worse, we're going to see gold come down here because a strong dollar also pushes gold prices lower. All right. Because most gold internationally is purchased via dollars. And of course, silver is going to be the same. Silver tends to have a higher beta than gold, but we're coming back down here. Now's not the time to go long these guys. There will come a time, but not right now. Okay. And then, of course, if we look at energy, and let's look at oil futures first. A lot of pundits are saying oil will go lower. I also have said oil is probably going to come down to the mid 80s. We came actually down to the low here at 85.73. I've got a support zone here in blue, which is a very tight range of about 85 down to 83 roughly, where we could see this. You can see the 50s over the 200, which is a bullish chart. You can see how oil has just slowly moved lower. I think we're going to stabilize around here and possibly move a little bit higher, but we're not going to get the action that we've seen over here from March to June. We're not going to get that kind of action. It's going to start to stabilize a little bit at a lower level and grind up or grind down a little bit. Members, you guys know how we like to trade this, and we've made money in oil all year long on some of the trades that we prefer. So that's a little bit about what I'm seeing in the oil market. All right, everybody, members, I will see you this Sunday evening. I got some other stocks to show you guys that we may want to take advantage of. If you're not a member, then I highly encourage you to come in and check us out. We're up this year, double-digit percentage returns in the high teens, 18, 19% annualized return. Markets are down. I think the rest of this year is going to be interesting. Next year is going to be a dollop, meaning it can move a lot, and we're going to play it like we did this year and have fun with it, make some money. All right, everybody, have a great weekend. Members, I'll see you Sunday night for our weekly market watch. Take care, folks. Ciao now.